Let us begin this module by understanding the term financial market. Financial market is a very broad term describing any marketplace where financial assets like stocks, bonds, currencies, derivatives and other financial instruments are traded. In a financial market, market forces determines the prices of various financial securities traded. However, there are certain government restrictions that regulate the amount of trading in these markets. Financial markets can be restricted to the operations within a country called domestic financial market, while it can be opened up to have buying and selling of foreign securities as well. The latter, taken separately, is called the international financial market. Opening up of the economy to the foreign securities necessitates an economy to balance its both domestic accounts and external accounts. External accounts for financial assets of an economy is called balance of payments. It is a record of all the international transactions of the current, the capital and the financial accounts of an economy with the rest of the world. Depending upon which kind of international financial instrument the resident of an economy is trading in, the effect on the balance of payment account will be different. For instance, if trading is happening through bonds, then it will have a different impact on the balance of payments accounts if the trading is happening directly in foreign currency exchange. In this module, we will study the international financial markets. What are the benefits of having trade in foreign securities? What are its benefits to the investors and borrowers? In section 4, we will study different types of international financial markets and what are the instruments traded in the financial markets. After studying this module, you shall be able to know the concept of financial markets, understand the benefits of international financial markets, learn what the different types of international financial markets are, identify the difference between appreciation and depreciation of exchange rates. Let us now understand the benefits of international financial markets. International financial markets play a crucial role for the economic agents who wants to park their funds in a foreign country. Investors typically invest in the securities of foreign country because they expect to earn an extra post-tax real rate of return which they get through the difference in the interest rates on foreign securities and domestic securities plus any expected gain or loss from any exchange rate variation. For instance, when investors expect domestic currency to depreciate in comparison to a foreign currency, or in other words, when domestic currency loses its value, they reap an extra benefit from international diversification over and above the interest rates differential. Indeed, they would then shift from domestically denominated assets into the foreign assets before the expected depreciation to profit in terms of the domestic currency. More importantly, risk factors are different in different countries. Diversifying the investment on international financial markets allow an investor to reduce his expected cost due to the different kinds of risk, especially political risk. An investor or a wealth holder would take into account the factors such as return, risk and liquidity to arrive at a portfolio of assets which maximizes his utility. International financial markets permits the investors a greater range of assets with which the portfolio can be made of. International financial markets allow the borrowers to borrow funds from the country in which interest rates are lowest. Moreover, if they expect the domestic currency to appreciate, they will gain during the repayment of the funds. If, on the other hand, the domestic currency were to depreciate, the advantage of borrowing at a lower rate could be either partially or fully eroded. There could even be a loss if the rate of depreciation were to be large enough to exceed the interest rate differential. Thus, depending upon the expectations of how the exchange rate would move, this geographical diversification helps the borrowers to reduce their cost of borrowings. By a similar logic, it would help the lenders to get a higher expected return for their funds. Another benefit of international financial markets is that the financial assets traded are highly liquid and the cost of transaction are low. This enables the large scale arbitrage operations. The opportunities for arbitrage arise when the rate of exchange between currencies, which should be the same in all the geographical areas of the market, temporarily become different in differing the geographical areas or segments of the market. Dealers engage in arbitrage operations all the time to take the advantage of these exchange rate differentials that occur in different segments of the market. Arbitrage is the process in which a dealer simultaneously buys an instrument of a foreign currency from a segment of the market where its price is low and sells it in the segment of the market where its price is too high. This operation is conducted by several dealers at the same time with large amounts. This operation, while yielding the profits to the dealer, has the effect of equalizing the rate in different segments of the market. If there are no restriction on buying and selling of foreign currencies, this kind of arbitrage opportunities will ensure that the price of domestic currency is equalized to the foreign currency in all the market segments. Next, we shall discuss the types of the international financial markets. Essentially, there are 5 types of international financial markets. However, different economists have different classifications of international financial markets. In this section, we will describe the different types of financial markets. These are the foreign exchange markets on one hand and what are known as the euro currency market, euro credit market, euro bond market and international stock market on the other. These markets are essentially offshore markets. They are often referred to as euro markets even though they have nothing to do with the European Union currency, the euro as such. Let us discuss them in detail. First type of international financial market is foreign exchange market. A foreign exchange market or sometimes simply called forex market is a market where currencies of different countries are bought and sold. The requirement of a foreign exchange market arises because different countries have different monetary systems. An individual who wants to visit Hong Kong on a holiday, which is a foreign country to him, requires currency of Hong Kong to incur his expenses over his holiday. He cannot use his domestic currency in Hong Kong for transaction. Thus, the need for foreign exchange market arises and the currencies are being traded in this market. Foreign exchange market thus promotes trade and international investment among the countries by enabling currency conversion. Demand for foreign exchange comes from the people who demand goods and services and financial assets of a foreign country at a retail level. At the wholesale level, it comes from the banks, non-bank financial institutions, large multinational corporations and central banks. These also act as the suppliers of foreign exchange. The modern form of foreign exchange market began during the 1970s. It was the time when countries moved away from the fixed exchange rate regime of Bretton Woods system almost nearly after 3 decades. Foreign exchange was then started trading on a flexible exchange rate regime. Foreign exchange market is basically an interbank market or interdealer market where large international banks around the world function as the channel of trade between the large number of buyers and sellers of foreign exchange. There are several levels at which this market operates. These large international banks turn to a smaller number of financial firms known as dealers. These dealers are actively involved in large quantities of foreign exchange tradings. These dealers are then directly linked to the buyers and the sellers of the foreign exchange. Some of the key features of this market are as follows. It is by far the largest financial market in the world. Given the huge volume of financial assets traded, it provides high liquidity to the assets. It is geographical dispersed as currency of any country can be traded on the foreign exchange market. The reach of foreign exchange market is said to be across the globe, with the principal centers being located in London, United States and Tokyo. It is operated continuously round the clock except on the weekends. There are two types of foreign exchange markets, retail and the wholesale markets. Retail market. Retail market deals with the exchange of banknotes, bank drafts, currency, traveller's check between the private customers, tourists and banks. Wholesale market. Wholesale market deals with the central bank and the other commercial banks. It is sometimes called the interbank market. To understand the operations of foreign exchange market, we need to understand the concept of exchange rates. The exchange rates represents the number of units of one currency that can be exchanged for 1 unit of another currency. For instance, if 1 US dollar can be exchanged for 50 Indian rupees, we say that the rupees per dollar exchange rate is rupees 50 per dollar. Thus, there are two ways to express the exchange rates: rupees per dollar exchange rate or dollar per rupees exchange rate. One is the reciprocal of the other. Thus, if rupees 50 makes 1 US dollar, then 1 by 50 or 0.02 US dollar makes 1 rupee. In other words, if rupees per dollar exchange rate is expressed as capital E and dollar by rupees exchange rate is expressed as capital V, then capital E is equals to 1 upon capital V. Note that one currency is usually expressed in terms of another currency rather than in terms of a commodity. For instance, if we say 1 US dollar is equals to rupees 50, we do not say that 1 US dollar is equal to 5 Indian bananas. Thus, value of one currency is expressed in terms of another currency. Given that rupees per dollar exchange rate is the reciprocal of dollar per rupees exchange rate, there are two ways in which exchange rates are quoted, one being the reciprocal of the other. First, direct quote. Number of units of domestic currency exchangeable for 1 unit of foreign currency. For instance, rupees 50 per US dollar. Second, indirect quote. Number of units of foreign currency exchangeable for 1 unit of domestic currency. For instance, 0.02 US dollar per Indian rupee. Exchange rate regimes may be represented by two extreme types, namely fixed exchange rate regime and flexible exchange rate regime. Under the fixed exchange rate regime, government fixes the value of currency either in terms of another currency or in terms of gold. If the demand and supply in the foreign exchange market forces the exchange rates to differ from this fixed rate, the central bank intervenes to either purchase or sell the foreign currency to make sure that the fixed exchange rates are maintained. Under the flexible exchange rate regime, the central bank stands aside and the exchange rates are determined by the market forces alone through the demand and supply of the foreign exchange. In practice, the foreign exchange markets, the usual case is for the markets to be characterized by managed floats in which the central bank allows the market forces to determine the exchange rates but intervenes to limit the fluctuations or to subserve some other objectives. Let us understand the appreciation or depreciation of a currency. A currency appreciation takes place when the value of one currency rises in terms of another currency. A currency depreciates if its value falls in terms of another currency. For instance, if rupees per dollar exchange rate falls, that is, earlier 1 US dollar was of rupees 50, now it is for rupees 40. It means that less Indian rupees are required to buy 1 US dollar. This implies that Indian currency has appreciated while the US currency has depreciated. If, on the other hand, rupees per dollar exchange rate rises, that is, earlier 1 US dollar was of rupees 50, now it is for rupees 70, then it implies that more Indian rupees are required to buy 1 US dollar. This means that Indian rupees has depreciated whereas the US dollar has appreciated. The rate at which the value of a currency changes over time is called rate of appreciation or rate of depreciation. Different transactions in foreign exchange market. There are different types of transactions that take place in a foreign exchange market. Let us discuss them briefly. First, spot transaction. A spot transaction is a 2-day delivery transaction which happens on the basis of exchange rate that is prevailing on the spot when the transaction occurs. Theoretically, the delivery of foreign currency or the instruments denominated in foreign currency should take place on the spot. However, 2 days are allowed for delivery to take place and hence it is called a 2-day delivery transaction. With improvements in information technology, the delivery will become feasible in a shorter time and so the transaction is likely to become more spot. Second, forward transaction. It refers to the transaction which is decided at the exchange rate determined at the time of the contract, which specifies the exchanging of currencies at some future point in time, usually at the interval of 30, 60, 90 or 180 days, irrespective of what the spot rate would be at that time. Third is swap. In a swap, two parties exchange currencies at a decided exchange rate for a certain length of time and agree to reverse the transaction at the later date. It is equivalent of a spot sale combined with a forward purchase, but with one difference, that is, there is only one transaction instead of two separate ones, thus saving the brokerage cost. Fourth, futures. Currency futures contracts are transferable, that is purchasable and saleable. So, currency future contracts are transferable contracts specifying a standard volume of a particular currency to be exchanged on a specific settlement date, but the exchange rate is decided at the time of purchase or sale. However, there is no need for the purchaser or the seller to go through with the exchange on the contracted day. This may be, I repeat, they may if they choose to close the contract by selling or purchasing their contracted obligations. Fifth, options. A foreign exchange gives the owner the right but not the obligation to exchange money denominated in one currency into another currency at a pre-agreed exchange rate on a specific date. The option markets is the deepest, largest and most liquid market for options of any kind in the world. A. Offshore financial asset markets. There are three different types of markets, namely Euro currency markets, also known as Euro money market, Euro credit market and Euro bond market. Let us discuss these markets briefly. First, Euro currency markets. The Euro currency market is a misnomer. It does not deal in euros as such and nor is it confined to the banks in the Eurozone. It refers to the currency deposits in bank outside of the country where it is legal tender. It would be a type of an offshore market. An example would be US dollar deposits placed in the banks of Europe is called Euro dollar or Euro currency. Euro currency market is composed of Euro banks which accept or maintains the deposits of the foreign currency, that is US dollar. Banks accept the foreign currency deposits because these deposits are not subject to the domestic regulations. For instance, banks are not required to maintain statutory reserves against their euro currency deposits and thus do not have to pay premium towards the deposit insurance. This allows the banks to normally lend these funds at the rates lower than those of their own currency deposits. The rate offered to the depositors too tend to be greater because of the higher risk that they face. A euro bank is not necessarily located in Europe and need not to be in Europe. It is a bank which accepts and maintains the deposits of the currency other than its own national currency. Asia also has its euro currency market referred to as the Asian dollar market. The primary function of banks in the Asian dollar market is to channel the funds from depositors to the borrowers. It also allows for interbank lending and borrowing. Second, euro credit market. Loans extended for more than 1 year by a euro bank are called euro loans or euro credit. The market that deals in such loans is called euro credit market. The common maturity for euro credit loan is 5 years. Euro banks accept the short-term deposits and provide long-term loans. This leads to a mismatch in the assets and liabilities of these banks. To avoid this situation, euro banks often extend loans on floating rate. The major participants in euro credit market are the ones who borrow and lend on the regular basis in this market. Some of these are euro banks, American, Japanese, British, Swiss, French, German and Asian banks, Chemical Bank, JP Morgan, Citicorp, Bankers Trust, Chase Manhattan Bank, First National Bank of Chicago, Barclays Bank, National Westminster and BNP. Among the major borrowers are the banks, multinational groups, public utilities, government agencies and local authorities. Third, euro bond market. A euro issued in a currency other than the currency of the country where it is issued is called a euro bond. In other words, a bond sold outside the country of currency denomination is called euro bond. An example is a Dutch borrower issuing the dollar denominated bonds to the investors in the UK and the USA. The euro bond market is the largest international bond market. It is originated in 1963 with an issue of euro dollar bonds by Autostrade, an Italian borrower. The market has since grown enormously in size and it is worth about $428 billion in 1994. They are used as vehicles for loans of a maturity that exceeds the duration covered by euro credit. While the market for these assets is global, Luxembourg has emerged as a primary listing center. There are some differences between euro currency and euro bonds. Euro currency loans are variable rates, have shorter maturities, have greater flexibilities and are obtained faster than the euro bonds. However, euro bonds have greater volume of transactions. There are some other forms of instruments that are traded in euro markets. These commercial papers, certificate of deposits and euro notes. B. International stock market. Multinational companies issue stocks to raise the funds. These companies have an option to issue stocks on international markets. This allows the companies to diversify their capital base, raise more capital, increase efficiency by increasing the competition, and can enhance the company's image at the international level. Stock issued in the United States by the non-US firms or government are called American Depository Receipts, known as ADRs, which are certificates representing the bundle of stock. Let us now summarize what we have learned in this module. Financial market is a market where financial assets like stocks, bonds, currencies, derivatives and other financial instruments are traded. Trade in foreign currency or the securities denominated in the foreign currency are traded in the international financial markets. There are two types of international financial markets: foreign exchange market and the markets for assets or instruments denominated other than the country of the economic agent. A foreign exchange market is a market where currencies of different countries are bought and sold. Price of one currency in terms of another is called exchange rate. Under fixed exchange rate regime, it is fixed by the government, while under the flexible exchange rate regime, the market forces determine the exchange rates. Euro markets are also called the international financial markets. Different types of euro markets are euro currency market, euro credit market and euro bond market.